winning 90% of your new business because you have some sort of incredible value.
I'm going to take a bit of a different angle.
I've got a budget this big. I'm going to give it to you because you have a really killer plan.
You give a Red Bull to a turtle, what do you expect?
I think that's a dead turtle. So let's move on to...
E-Rig.
Cheers.
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 Does your current premium finance company lock you into long-term agreements? That's because they don't want you talking to us. At IFS, we win your business the good old-fashioned way, with customer service. I know you don't always have to use a premium finance company, but when you do, you should use IFS. Cheers.
Hi there, and welcome to the Digital Insurance Pint podcast. As always, I'm your host, Tom Reed, and I'm joined by my colleagues, Steve Earle, CEO of Bald Insurance.
Hello.
Adam Mitchell, CEO of Mitch Insurance.
Hello.
And Jeff Roy, CEO of Excalibur Insurance.
Welcome, Pinters.
And today we are super pleased to be joined by industry veteran and all-around good guy, Alister Campbell. Hey, Alister.
Hey, I brought an espresso instead of a pint.
Awesome. Well, now we know what keeps you up at night, caffeine. So, Alister, for the 7 people in the industry who don't actually know who you are, could you give us a bit of a background about yourself?
Sure. Thanks, Tom, and thanks for the invitation to the rest of the Elite Pint team here. Appreciate the chance to talk about some of the fun stuff we're working on at PACCIC. But I'm 40 years of this insurance industry now, apparently. I started out helping create the first broker consolidator way back when, early in a career, and had a couple of stints at the kind of the personal lines end of the industry and ended up on the commercial lines and specialty end of the industry. I got to be CEO of a couple of companies in my career. And now for the last 6 years now, I've had the honor of running PASIC, which is literally the best job in the world because we haven't had a phone call since 2003.
So for those who don't know what PASIC is, could you give us a 30-second rundown on what the role of that organization is?
Sure. You know what CDIC is? It protects your bank deposits if your bank goes bust. That's a Crown entity. PASIC is the property and casualty insurance industry's solution to the same problem. If a Canadian property casualty company fails, we will step in to protect the policyholders.
Fantastic. All right. And to get to know you a little better, Jeff has some rapid fire questions for you. Go ahead, Jeff.
All right, we're going to start off here in rapid fire, but we've got some stuff customized to you, Alister. You were a message guy in politics before insurance, and I think we might even have to go back to a guy named Mike Harris back in the 90s, right? With all your experience in both insurance and politics, who's a harder sell, an interior voter or a commercial underwriter in a hard market?
There's no hard market. I guess would be the short answer to that right now. So the honest answer is voters are always harder. Underwriters tend to be pretty binary, and brokers do their best to get them to think in at least another dimension. But voters change their number one issue through electoral cycles and over time. And what drives their vote can be very different from what you expect. So I would say, as human beings, voters are much more complicated than underwriters.
Okay, great answer. Next question. What insurance buzzword needs to be retired to the Pints composite bin?
Early in my career, I learned that synergy could be overused, and that was a long time ago. And I did my best to never say it out loud again. It was financial services synergy. And the idea was that you could have a one-stop shop that would have banking and life insurance and real estate, property casualty insurance all in one. And turns out it was really hard to put very different things together and make them one thing. So I would say synergy would be the one that I've ruled out pretty diligently over my career since.
Oh, that's good. Well, 1 + 1 doesn't equal 5. That's a great one. So there you go. Last question on our first episode here, and we're lucky to have Alister for 2 episodes, and we'll get you on the flip side. Alister, you've seen the industry go from paper files to AI. Is there one analog thing about the insurance business you hope never goes digital?
Well, the thing about our business, I think, is it's it's a market as much as it is an industry. And the thing that I think we probably all value the most is the human interactions. You get to be friends with your enemies, with your direct competitors. We know each other socially and engage in the collective effort to make insurance and risk transfer work better for people. And so that human interaction, I think, is the central element to what makes our industry so successful. And I'd be very sorry if we all ended up only digitally interacting in the future.
I think that's well said. The 40th laws of power by Robert Greene: keep your friends close and your enemies closer. So I think that's wise advice, sage advice in the insurance industry.
I'll loop back to, you asked me about politics at the start. There's a great line about if you've been in politics long enough, the only friends you've got left are your enemies.
Well said, well said. All right, that's it for the rapid fire for round one.
This episode, like all of our episodes, is brought to you by IFS Premium Finance. So thank you very much, guys, for all you do. And we're going to dive into earthquake risk and systemic collapse, which sounds like a interesting and scary conversation. And I'm going to get Adam to go first because he is the least scary of all of us.
Thanks. So, Alister, we've heard you talk about the tipping point, and a title of that as it relates to major earthquakes, and ones that don't just break a few companies, but possibly threaten the entire P&C industry. For the people listening and driving, how close are we to that edge, and what does the morning after look like for the average broker?
Okay, so that's a lot in that question. So I'll start by backing up. And how close are we? It could happen this afternoon. Canada is seismically at risk in two different parts of our big wide country. So we could have a severe shake off the coast of British Columbia that would threaten everything we know on Vancouver Island and through into Vancouver, Richmond, Surrey, White Rock, North Delta. But we could also have a major shake in the kind of Ottawa-St. Lawrence River corridor, kind of would roll down from Charlevoix in Quebec and shake well past the Parliament buildings in Ottawa. And the insured values in the Quebec scenario are actually more horrifying, though the risk of that is slightly more remote. So Canada is quake exposed. But to your very practical question, how much risk are we at? We are safer from an insurance industry perspective than almost anywhere else on earth. We have very high capital standards in Canada. We have strictly supervised insurers that have margins of safety from a balance sheet perspective that are exceptional. And as an industry, we are required by the federal or provincial supervisors to hold capital at the insurance company level and reinsurance on top of that, adequate to withstand a 1 in 500 year event. So the event that's going to cause a systemic crisis for us is probably past that. I say probably because the models are only models. And we haven't had the significant shakes that could cause that much damage since the 17th century in Canada. What we have is oral history from First Nations that tells us how bad these things were in the 1660s. And so the science is as good as it can be, but there's a risk that it's just worse. And obviously a lot has been built by us settlers since we arrived, since the 17th century, that is more exposed to that kind of shaking. So it's not likely to happen, but it will happen. And when it does, our industry is at risk simply because there is a scenario where the shake losses are worse than our capital and reinsurance in total. And so at PACCIC, we've handled 13 failures in our history. They were all small, poorly managed companies. It was a schmozzle. It was a miserable experience for the industry, reputationally, very challenging for the brokers, very expensive for PACCIC to clean up the mess. We invoice the industry for it. So every insurance company has to pay their share of the losses of the failed competitor. But we have never had multiple companies fail, and we've never had companies fail en masse after a major natural catastrophe event. And that scenario is why we have something we call the tipping point, which is the point where the invoices we send out to the industry after to clean up the wreckage of multiple bankruptcies bankrupts the rest of the industry. And so at that threshold, we move from an industry problem to an existential problem for Canada. And there is no other nation on earth with this much earthquake risk that doesn't have some kind of risk-sharing plan in a drawer for that, except Canada. Chile has a plan. New Zealand has a plan. Japan has a plan. Canada does not. And it's just a kind of inexcusable gap in our system. And they're all different plans. Japan runs their solution differently than Spain does, than New Zealand does. But everybody has something. We have nothing. And so I don't get to retire at PACCIC till we fix that.
So why don't we have a plan, Alister?
So first of all, I guess remote tail events are really hard to plan for. I mean, you folks as brokers spend all your time trying to explain the risk scenarios to a client and persuade them that they need to buy more cover for something they don't think is going to happen to them. So the country buying insurance, if you will, against a big earthquake risk is no different than a commercial client when you're trying to explain how much exposure they have to a risk they don't consider serious. So that's the first reason, is it's human instinct to resist thinking about bad outcomes. Second is I think people have seen it as a regional problem, and that's hard to get a national solution for a regional problem. You know, why should the policyholders of Saskatchewan be paying anything extra to protect from Vancouver shake or Quebec, Montreal shake? You can see the difficulty in our federation of getting a national solution to a problem that is widely seen as regional. I think since 2017, Tom, the federal government has 4 times now promised in a budget that they know they got to do something about this, and they will. The first 3 times it hasn't happened. The 4th time was last November. And suddenly a whole bunch of things are moving in the right direction. So I'm more optimistic than I've ever been about this file. But it is hard. If you picture the Prime Minister's desk right now, there's probably kind of some tariff issues, and there's probably some housing policy issues, and it'd probably be pretty hard to fit almost anything else on your desk. And remote tail earthquake risk is it's right balancing on the edge of the corner.
How much warning do you expect to get, or how much do we know about earthquakes? And for the layman that me doesn't understand, like it's not like a normal insurance product where you can model frequency and severity. Severity may be a little easier, but the when, and is it an inevitable because of global warming? Is it that these things eventually always shift?
Honestly, if we could have worked out some way to connect quake risk to climate risk, we would have probably moved this file forward faster. The Earth will shake completely indifferent to what temperature it is on the surface. And in terms of how much warning you will get, easily 15, 30 seconds. So there is no science to tell us when this is going to happen. There is good science to tell us it will happen. And so we know it will. The folks in British Columbia have felt regular shakes since they were school kids. The folks in Quebec have felt that less. 1989 would have been the last one that kind of was significant enough that we felt it in Toronto. It's because it's a very shallow plate, as I understand this stuff, and it just travels a long distance. But it wasn't a big enough shake to cause material damage. But we know the Charlevoix quake in the 1660s, severely shook Boston.
Like severely, it would do damage in Toronto or that sort of vicinity?
Through Eastern Ontario. Most of the damage would be kind of Montreal and the fire following. is going to make things miserable because all the water mains are broken and the fire trucks can't get anywhere. And if they could, the hydrants don't have water in them. So there's so many bad things that happen when a really big shake happens. And we've seen this on TV. We know that this happens to other people. We just haven't thought properly about the reality that it will happen to us.
Well, for politicians, is it likely to happen in the next 4 years during their term? During their term?
Yeah, that's why it's so hard. That's a great question. And that's why this stuff is so hard. It is a remote tail risk. And there are so many other short-term problems to fix. The reality, though, is if you have a plan, you can put it in the drawer and you don't have to pull it out again until something happens. But if you think about what our country went through, what the world went through with COVID, it would have been better to have a pandemic plan in a drawer. And there were people who took pretty good notes during SARS. But none of that stuff was properly kept in the right desktops and the right binders in the right hands. And so everybody was freelancing and having to make up public policy on the fly. And we all know how that went. These tail risks do happen. That's why you brokers are always trying to explain to your client that they should be doing a proper risk evaluation. What could go wrong with your business, right?
What's the cost of making the plan? Like, aside from having to do the work, how what's the dollar figure that's being shirked by not having a plan?
Well, there's consequences, I would say, in the insurance marketplace. So, for instance, the price for earthquake insurance is more than X. And in Quebec, that means that the take-up rate is maybe 5 or 6%. Now, fire following is covered, so there'll be lots of losses, and commercial's covered. But the take-up rate in Quebec is super low. More serious, maybe even, in British Columbia, the prices have been climbing. The industry has introduced exclusions, so losses from tsunami are now excluded. Losses from liquefaction of soil are now excluded. And most significantly, apart from raising prices, quake deductibles. There's a sublimit quake deductible, which is now risen from what used to be 5% to as high as 20%. So at that point, for most consumers, the product actually will fail to respond. So the industry is rationing capacity to this exposure precisely because there is no plan against the worst case scenario. And so that's leading to very unhealthy outcomes in the insurance market.
Yeah, I was thinking about, like, I presume the cost to generate a plan is a engagement with a series of professionals that are going to do some good thinking and some good researching during these quiet periods where they can basically leave on the desk for future generations, break this glass in case of quake, and here's most of your thinking. And you can presume they're going to be nimble at decision time. But in the grand scheme of things, this doesn't feel like making the plan is a great cost.
No, but there is a commitment that's required. So let's just give an example. So the reason I'm so optimistic is that in February, the federal government actually launched a consultation on this. And it wasn't a big, broad, every stakeholder can give their view consultation. It was a narrow insurance specialized consultation with an April 10 deadline. So after 13 years of begging for this, we suddenly got 7 weeks to come up with what precisely would we recommend. So you're looking at the dog that caught the car right now. We're working pretty hard to go to Ottawa this Friday with our recommendation. But the IBC, on behalf of the insurance companies of Canada, is going to Ottawa and saying the solution should be some form of TRIA-like mechanism. So what's TRIA? So TRIA is the terrorism program that the United States introduced weeks after 9/11. So if you back up to that awful event, the towers fell, and the next morning, commercial property insurance was unavailable in New York City, or LA, or Chicago, or Dallas. And so within weeks, Congress established a backstop mechanism that said that above a certain size of event, the industry would share the losses with government. And so that program capped at $100 billion US dollars. And the industry would pay back whatever it received over a period of years in the future as a levy against future policy premiums. So that program has been in a drawer, reviewed by Congress every 5 years and renewed. Thankfully, it's never been used, but it's there. And as a result, commercial insurance for office towers in New York and LA and Chicago and Dallas and Houston is available. So some kind of arrangement like that is what we need for Canada. It sits in a drawer, but there is a very large sum that would be readily available on pre-negotiated terms to protect policyholders after a terrible event that will be paid back later. And that's just a question of negotiating the terms and then the government understanding that this is now one of their contingent liabilities in future.
I would think that would makes a lot more logical sense because you're doing it with forethought, ahead of the curve with the plan, as you said, in the drawer, as opposed to make it up as you go. There were some smart people writing stuff down on SARS, but we all know how much money was spent, probably overspent and wasted, putting us in a bad position further on, that if they had that due diligence on COVID, how much better things would have been ran, how much better we would have came out of it. Likewise, having this plan in place would allow the government to navigate it way better and, provide a lot of, people freaking out, the whole psychology of when markets crash, the whole mentality of everybody trying to pull everything out and do stuff drastic on emotion instead of logic, right?
Completely. And so, and it would also lead to a change of behavior for the industry. So right now, I'm required by OSFI or the AMF in Quebec to hold to 1 in 500. But I don't just hold to 1 in 500. I have a buffer on top of that. There's some companies that buy 1 in 1,000 a year, and they have to charge that through to the customer, your customer. And so if there was a backstop that guaranteed that above X, the losses were shared with the federal government, the industry would be able to redeploy capital, probably to write more earthquake risk for more people at a more affordable price, maybe with less onerous exclusions and maybe with less onerous deductibles. So it would have positive impacts all the way through the system.
Alister, can you explain for our viewers what 1 in 500 or 1 in 1,000 means?
Sure. So I will do this only as a layman. I will only do this as a layman because I'm no seismologist either. But basically, there is a range of possible shakes. And a 1 in 500 year is the best science as to the probability of a shake being as big as X. And so super rare. We can't find any other country in the world that regulates higher than 1 in 250. So Canada is really conservative on this, which is why it would have to be a really big shake to cause the tipping point problem. But it's also, as I was about to say a minute ago, in a separate thing, not wearing my PACCIC hat, I'm a senior fellow at the C.D. Howe Institute, and I did a benchmarking study on Canadian insurance premiums relative to the rest of the developed world. And Canadians pay the highest property insurance premiums I can find anywhere as a percentage of GDP. And why is that? One, because we have higher capital and prudential standards than anywhere else. That's at least one reason. The other probably big one is that everywhere else in the world, at least some share of major perils is shared with the government. The US has a flood program. New Zealand has a quake program.
Spain has a good program, right?
Spain has an amazing program. 1% of premium every year paid into a fund, which miraculously the Spanish politicians have never grabbed. And all nat cat risk is covered by that fund.
So those floods in Valencia, what was it last year? They were paid for by that fund, right?
They were, the Consorcio. Yeah, I was over in Madrid at a conference, and I work with the guys at Consorcio as part of the international network of things like PASIC. And they're super interesting. I asked them, what are they doing about the fact that they're just rebuilding stuff in a floodplain? And they said, oh, that's not our department.
That's fascinating, actually, Alister, because I didn't know that Canada was like the most expensive, relatively speaking, for property. I mean, I've seen. I mean, I've lived out west most of my career, and I've seen the BC quake reinsurance rates go up. The deductibles go up. Percentage of people buying it go down. So interesting. Is that potentially on the docket to talk to the government about in the context of this whole tipping point thing?
Well, the real issue here is one of the solutions would be to just start paying more money into a fund like PACCIC. I have $65 million in the bank. What if we just started accumulating more money in a PACCIC fund to solve this earthquake problem? And the answer is, if you're going to ask the industry to hold huge levels of capital, plus buy massive amounts of reinsurance and contribute more to a fund, all it does is further increase very high premiums. And so it's probably better to have a payback later plan than it is to have a pay upfront plan, because we're already paying such a high price for the conservatism that's embedded in our system.
Right. So maybe take away some of that conservatism and leave it for the future. Is that kind of where you're going?
Yeah, well, except that this might not happen for another 200 years. So putting a whole bunch more capital in the bank for something that might not happen for 200 years seems like a waste of capital. I'd much rather have it back in premiums. And so to have an agreement that there will be money available from the government that would be paid back later, so it's cost neutral to the taxpayer over time, I think is probably the most rational way to manage this particular insurance design problem.
So right now, Alister, 1 in 500, nobody goes tits up.
Maybe somebody does.
1 in 1,000, some do.
Yeah, maybe somebody does at 1 in 500. You have to think about it this way. All I can do in the PACCIC model is assume that everybody gets equal share of the losses based on their market share and exposure and PML for property. We know that there'll be some people who are lucky and some that are unlucky.
Or skilled and unskilled at underwriting.
If you think about recent cases in Fort McMurray, there was an insurance company that had 4% market share of the province. They happened to have 16% market share of the town. And so their losses were way beyond what most people expected in the model. That will happen when the shake happens too. So you could have a smaller, regionally focused and unlucky company fail. But at 1 in 500, it's likely that the PACCIC mechanism would be robust enough to withstand that. We'd be able to look after the claims of the policyholder and send out an invoice that the industry could afford. It's somewhere north of that the problem becomes severe.
Your mandate is to protect the policyholder, not every single insurance company.
Correct. It's healthier for an industry to have a risk of failure. You want to have innovation. You want to have competition. You want to have more choice, not less. So in the end, it's better to have a policyholder protection mechanism when failures happen than try and run with zero failure. Some people would argue that the 1 in 500 is too prudent and costing policyholders a higher premium than they otherwise might need to pay. So there's a balancing act here. Canada really prefers zero failure, and we haven't had any in a while. So,
well, 1660 was 350 years ago. So
Champlain was just about to arrive. That's right.
So we're 350 years into the 1 in 500.
Yes, we are.
Thing. So interesting. So if one or two small regional players fail, could that outcome actually ripple across the industry, or would PACCIC be looking after that to prevent the...
Yeah, we'd be okay. I think we'd be all right, honestly. Important caveat, we don't pay full policy limit at PACCIC. At the moment, we pay up to $535,000 for a property claim. So I'm going to go rolling right back to the question that started at the top. What would this mean for the broker the day after the big shake? Well, first of all, if you recommended to your client that they be insured by somebody who failed, once they discover they're only getting PACCIC limit, the next limit they'll go after is your E&O.
So what's the underlying message there, Alister? Make sure that whoever you're insuring your clients with has in excess of the minimum capital requirements?
Yeah, I think brokers, in theory, have always had an obligation to do that. Because we haven't had a lot of failure over the last 20 years, I don't think brokers have probably spent quite as much time looking at the solvency of the companies they're recommending.
For the minimum capital, what's the good number? At what point do you get comfortable? Is it 200? Is it 300? I mean, where do you?
Well, PACCIC, the higher the better. But practically speaking, if you're a big geographically diversified company, you can run below 200. If you're a specialized player in a couple of liability lines, I think most people would prefer to see you north of 240. The industry overall runs at about 240 right now. But the consequences of that are probably a rather soft market.
Quick question. I don't know if I can jump in here, and I'm not sure the best place to put in this. There's a few other things besides obviously the quake, Alister. I don't know which ones are real and legit, but let's say a banking failure, market crashes. Which ones of those are real, the real deal? Which ones do you think could break the system? Which ones, are true solvency problems, and which ones are kind of really liquid confidence or contagion-like problems? Like, is there anything else besides quake? That's the big doozy. But, a banking failure wouldn't be too good. Like we saw with the market crash in 1929, obviously some effects. Are we protected enough with our capital for these other things, and there's less of a threat? Or how do you feel? Is there any other ones that keep you up at night?
Super fun question. So honestly, the short answer is that the quake scenario is the most likely and the most severe for PASIC. We don't actually think of it as just quake. It's what would cause a loss of over $45 billion, insured loss. And that's a short list in Canada. Fort Mac inflation adjusted is 6. So the 4 big ones we had in 2024 combined were 9.4. 45 billion is a long way out there on the curve. And so our list for that is earthquake, asteroid strike, and severe space weather phenomena that fry the entire electrical grid of the planet. It's a short list and it's pretty remote. Of that list, the thing that could get Canada most likely is for sure quake. Now, to your question about the financial markets, if you want to think about the most recent trial experience, financial crisis, global financial crisis, 2007, 8, 9, right? How many P&C companies failed? None. Right? It was a problem for banks. It was a problem for asset managers. It was a problem for some life insurers. And AIG got in trouble, but not because of their insurance biz. So we are really dull, the least leveraged, the most prudently reserved, and the things that can really do damage to us are uncorrelated with financial markets. Like the wind will blow or the earth will shake, and it doesn't care what the Dow Jones is that day. And so we are, and because our payment obligations only attach to claim events, we don't have the same urgent liquidity crisis that you run into when you get a run on a bank. So, the Canadian banking system, like most of the world, makes long-term loans backed by overnight money. So if confidence fails, it's an almost instantaneous infarction. Whereas, if you hear that your property casualty insurance company is in financial distress, you go get insurance somewhere else. You don't rush out to crash your car before your neighbor does. We don't have runs in the property casualty business the way the banks can. So on our list of things that really cause stress, it's more likely to be a climate risk or a quake scenario, uncorrelated with financial markets.
That's interesting about solar flares and asteroids. It's it's interesting. Those are things that the black swan events that you hope never happen.
Correct.
Right?
And all the big reinsurers of the world have scientists just on those files, because when those losses happen, they will come rippling promptly back through to Swiss Re and Munich Re and and Mr. Buffett.
The one before that, where do you guys map the Trump blood sugar decision making risk on the PASIC map?
So it's fun to think about theoretically, right? Geopolitical risk was not in a top 10 risk register for any property casualty insurer 4 years ago. And now everybody's thinking about it, but mostly because it has an impact on our clients. Any commercial client has got some exposure either to higher prices than they planned or changes to the tariff rate at which they get to trade with who, with supply chains that are disrupted, etc. So most of the risks from a geopolitical perspective are just bad for Canada, which is always bad for our industry, or they're bad for our clients, which could be bad for any broker. But geopolitics by itself cannot destabilize an industry as well capitalized as ours, as well reinsured as ours, that sells annually renewable policies. If something's going bad, the underwriter can get off.
So, Alister, PASIC has been working on, you call it a bridge insurer?
Sure. Yeah, because we just got our charter last year. So I'm actually CEO of an insurance company again as of January 1st. So why do we have this? It's a shell entity. It sits in a drawer in my desk at the office, and hopefully will never be used. But in a crisis, there are scenarios where you have a company that gets in trouble because of one line of business it wrote, and the rest of the company's fine. And you could actually find a buyer for the rest of the company, but nobody's going to buy the whole thing because of whatever this toxic liability pool is. That probably is hard to estimate the liabilities on. And so you could break the company up into good company, bad company. You could sell the good bits, could put the bad bits into PACCIC, General Insurance Company, and PACCIC would manage it in runoff, funded by the industry. And that would be a cheaper outcome for the industry than funding the entire bankruptcy of the entire entity, with better protection for policyholders. Because if we can sell, let's say they wrote business interruption loss and forgot to exclude pandemic, as an example. You could sell the home and car insurance business easily, but you couldn't sell the commercial portfolio, at least for the 3 or 4 years it takes to work out the forensic accounting on what the BI losses are. So you'd sell the home and car business. Those policyholders would not be forced to live with PACCIC limits. They would have policy limit on renewal with their new insurer. And the bad stuff would stay in an insurance company and get managed and run off separately. So it's a tool for buying time for the regulators and the industry in a crisis in a couple of very distinct scenarios. CDIC has a bridge bank tool that they can establish in 48 hours. So they can split good bank, bad bank. And the life insurance guys that do the same thing as PACCIC in Canada called Assurus, they have a company called CompCorp Life, which they've used in a crisis, but which now is back to being a shell with no liabilities. So when we were doing our inventory of what could go wrong, separate from quake, you could have a single big company get in trouble for kind of idiosyncratic reasons, or their own unique business reasons. They made a mistake on something. Having a tool like this sitting in a drawer for my provincial and territorial license fees a year is definitely worth it for the industry. And I could have that up and running. I have $65 million in the bank. I have a $250 million standby line of credit. So I could have $315 million of capital in a shell entity up and running in 48 hours.
So an insurance company gets an infection that's probably going to kill them. You can cut it out.
Correct. Yeah. And just better for everybody, lower cost for the system, way worse outcomes if you let it fail from a reputational impact for the industry, reputational impact for the brokers who recommended that company to their clients, and better outcomes for the policyholders.
So why don't we look to wrap up this first episode here? Alister, you mentioned earlier that most people don't like looking at the bad things. It sounds like that's essentially what you do on a day-to-day basis, is poke your nose into the dark corners of all the bad stuff that can happen. How's your mental health these days? Are you still doing okay?
Well, I find this stuff interesting. And maybe that is just weird. Honestly, it's not much different from the underwriting perspective I've got to be part of for 40 years. You're thinking about what the risk-reward trade-off is for certain profiles. But I've really got to learn this industry, and I really enjoy this industry. And I'm getting to provide what I think is a good service to both the industry and the country in this role. So the fact that I'm spending a lot of time on what could go wrong, I think I've always done that in insurance. But to be doing it kind of on behalf of the industry as a way to finish my career in the industry has been really satisfying.
Is retention important to your brokerage? Of course it is. That's why at IFS, we have a cancellation prevention process. Want more details? Give us a call. I know you don't always use a premium finance company, but when you do, you should use IFS. Cheers.